In this video, I'm going to share 3 ways to start earning massive dividends with a $10,000 dividend portfolio. As long as you conduct a thorough due diligence, dividends are a passive income source that can help pay your bills now, or you can reinvest it for later. So whether you plan to live off the dividends or just want to let it grow, here are some of the best ways to earn high dividends through a small portfolio. If you're willing to do some aggressive research and enjoy hunting for opportunities, then investing in individual stocks might work for you. If your goal is to achieve the highest dividend income possible, then obviously the first screening is for high dividend yield, but that's just the start. You also want to look at the dividend payout ratio because this indicates how safe the dividend is. The lower the better. If a company is paying more money out in dividends than the business itself generates, that dividend is unsustainable. This ratio is typically calculated using earnings or free cash flow or even funds from operations or FFO for certain REITs. It just depends on the industry. You also want to look at the company's dividend growth history. A superb dividend stock will demonstrate a long track record of consistent dividend increases. How much growth you should expect depends on how high the dividend yield is already. Generally, the higher the yield, the less room the company has to grow it. One stock that might be worth looking at and that I am personally keeping an eye on is AGNC, which is a mortgage REIT. This company pays out a dividend of around 7.7%, which isn't unusual for these kind of REITs, which are known to pay out very high dividends. However, keep in mind that many of them are risky and complex businesses. Last quarter, AGNC generated 76 cents in earnings and paid out 36 cents in dividends, so the dividend is well covered for now and for the foreseeable future. This is because their average cost of funds has declined dramatically compared to their average asset yield. AGNC, like many other mortgage REITs, profit from the interest rate difference in the mortgage-backed securities it buys compared to the interest it pays for the short-term loans it uses to purchase those securities. So as long as the Federal Reserve keeps short-term interest rates at zero, AGNC is able to capitalize on this spread and use it to pay its massive dividend. Now, it did cut its dividend in 2020 during the depth of the COVID crash. However, Gary Kane, the CEO, made it clear in a recent earnings call that in hindsight, the dividend cut was unnecessary. The company's operations remained stable over the past year, and it was just a precautionary decision. So if you prefer to do your own research and buy individual dividend stocks like AGNC, make sure you hold around 20 stocks to be diversified enough to reduce company-specific risks as shown here. This comes from the investment bank Raymond James, and it is broadly consistent with other studies that try to determine the optimal number of stocks you should be holding. So once you approach around 30 companies or so, it may not be worth your time and effort to keep a tab on all those companies, at which point you might just be better off with an ETF. So if you're interested in getting started with dividend investing, right now Webull offers 2 free stocks worth up to $1,850 for opening an account and depositing $100. Webull is an online trading platform that is commission-free, no minimum deposits, there's no cost to use the basic service. So you can try it out and get free money just by signing up and making a deposit. So claim your free stock now by using the link in the description, and by doing so, you also help support this channel, so thank you. If you want dividend income in a more passive way, then investing in high yield dividend ETFs might work for you, and these come in all sorts of varieties. The most straightforward ones simply own a basket of high dividend stocks and give you immediate diversification, so your initial investment isn't at risk. SPYD is a great example of this. This is the Spider Portfolio S&P 500 High Dividend ETF, and it holds 80 high dividend yielding companies in the S&P 500, focusing on large cap companies and REITs. It's well diversified across 10 different sectors, and it charges a very low expense ratio of 0.7%. But the problem is it only offers a yield of 4.5% as of this recording. While that may seem high compared to the broader S&P 500, if you really want income, there are certain sectors like mortgage REITs that offer much higher dividends. If you're willing to trade broad sector diversification for bigger dividends, midstream energy companies might be worth looking into. One of the largest and oldest midstream energy ETF is the Alerian MLP ETF, and it offers around an 8% dividend right now. If you look at the historical yield, that's actually the norm. The industry appeared to be in distress since COVID, but has since recovered and has been thriving with the anticipated reopening of the broader economy. The ETF holds 19 MLPs currently, or Master Limited Partnerships, and these are special companies created by Congress that have to pay out 90% of their income to their shareholders, also known as unit holders. They are pass-through entities, meaning all profits and losses flow to the unit holders so their profits aren't taxed twice like traditional companies. This is why MLPs can pay out such high dividends. But the problem with MLPs and the Alerian MLP ETF in general is that if you look at its price, there has been no appreciation over the last 10 years. And this is true of other MLP ETFs like the MLPA, the Global X MLP ETF. Its investors have also suffered from a lack of capital appreciation. This may be partially attributed to stagnant oil prices over the past decade, even though MLPs are somewhat insulated from it. But to make matters worse, MLPA and the Alerian MLP ETF in particular have very high expense ratios, 0.46 and 0.9% respectively, which is a drag on your overall returns. So we basically traded one problem for another. So is there any way to get a good balance of excessive dividends, broad diversification to limit risk, realize some capital appreciation while keeping expenses low? One of the best ETF that balances these competing goals is JEPI, which is the JP Morgan Equity Premium Income ETF. I've talked about this ETF in depth in a previous video on the fastest way to live off dividends, and it continues to be one of my favorite dividend ETFs. However, if you aren't familiar with it, it's an actively managed fund that offers around a 7.5% dividend yield with an expense ratio of 0.35%. About 80% of the fund invests in low volatility stocks, while the remaining 20% invests in equity-linked notes or ELNs. It generates excessive dividends by selling covered call options on those ELNs, which allows the ETF to pay out monthly dividends. If you want to learn more about what ELNs are, I recommend checking out that video. By limiting the portion of the fund that covered calls are sold on, JEPI doesn't suffer from the common problem with traditional covered call ETFs, which is limited appreciation. Selling covered calls basically means you give someone the right to buy your stock position if the price of the stock exceeds the strike price of the options contract. If the stock price goes above that strike price, you forfeit all the gains above that, which limits your gains. From a tax perspective, unlike stocks that pay out qualified dividends, JEPI and traditional covered call ETF dividends are much more complicated due to the option strategies they deploy. Depending on how the strategy works out given the market conditions, a portion of the distribution may be taxed as short-term gains, a portion may be taxed at the more favorable long-term gains, and some of it may be treated as return of capital in which taxes are deferred until you sell your position. The next way to invest for massive dividends with a small portfolio is through Fundrise. Fundrise is a crowd-funded real estate investing platform that was founded in 2012. It pools the capital from small investors to get access to private commercial and residential real estate. Its aim is to make high-quality real estate investments available to everyone at a low cost, because real estate has traditionally been an asset class that was only available to high net worth and institutional investors. Now, the way Fundrise is structured, as you'll see in a minute, makes it challenging to live off dividends immediately. However, I think it offers a very strong value proposition if you want to diversify beyond stocks. It offers comparable dividend returns to what I've already shared, and more importantly, based on 10-year moving averages as shown here, real estate is not as volatile as equity or stocks. Fundrise offers what are called E-REITs and E-funds. When you open an account with them, your money will flow to one or more of these investments. Based on the objectives, you can see that some focus on income, some focus on growth, and others focus on both. If we take a look at one of these like this income E-REIT, it started in December 2015. Its current dividend is around 5.5%. And if you had invested $10,000 since 2016, it would have grown to about $15,500 up to now. And this is with dividends reinvested and net of fees, which we'll talk about in a minute. In terms of total dividends, this E-REIT paid out 7.2% in 2020, 7.8% in 2019, 8.1% in 2018, 10.4% in 2017, and 9.2% in 2016. And it currently has 14 projects across several states, but mainly California and Florida. Let's take a look at one more fund. So going back, all right, how about here? Income E-REIT 2019. This one is a bit newer and offers a dividend of 7.88% right now. A $10,000 investment since inception would have grown into about $11,800 as of today. And you can see here that so far in 2021, it's generated 2.9% in dividends, which is really high. If you annualize that, we are looking at about an 8.7% dividend projected for the year, and that seems consistent with what this fund generated last year with 8.9% in dividends. With $10,000, there are different account levels you can get started with depending on how much you want to invest. You can get your foot in the door with as low as $500 with a starter level, but you get minimal benefits as opposed to a basic or core level or any of these other higher level accounts. And this is important because accounts at core level and higher allow you to select one of the 3 investment plans shown here. If you're investing for dividends, the supplemental income might be your preferred choice. This plan allocates your capital more towards cash flowing e-REITs or e-funds at around 70 to 80% of assets, as opposed to growth oriented investments that hold about 20 to 30% in income focused assets. Now, compared to other real estate crowdfunding platforms, I find that Fundrise often ranks at the top, like on millennialmoney.com. The site considers it to be the best overall. And then over on NerdWallet, the website rates Fundrise 5 out of 5 as being best for non-accredited investors, which basically means you don't need a lot of money or have $1 million or more in assets to invest compared to some other crowdfunding platforms. And over on investingsimple.com, they consider it to be the #1 pick for beginners and at the top of their list in a matchup between 11 platforms. However, there are some downsides, especially around cost and liquidity. When it comes to cost, Fundrise isn't cheap when you compare it to low-cost index funds and free trading apps like Robinhood or Webull. They charge a 0.15% annual investment advisory fee plus a 0.85% annual asset management fee. So if you invested $10,000 on the platform, you'll be paying about $100 per year in fees. However, the silver lining is that Fundrise allows its investor clients to own shares of the company itself through the Fundrise IPO. So in a way, you would get your fees back as a shareholder. If you're an existing investor with an account level of basic or higher, you're eligible on a limited basis to buy shares of the company as a percentage of your existing portfolio, and those shares over the last 4 years have increased from $5 to $11. Based on my conversations with Fundrise, your chance to invest in the IPO opens up at some point during your first year of investing. And having a certain account level or upgrading your account won't expedite your window to potentially invest in the IPO. But there is another cost you don't want to ignore. Dividends from Fundrise are not taxed at long-term capital gains. They're taxed as ordinary income, which means you'll be paying higher taxes on these dividends as opposed to qualified dividends from stocks and ETFs. Furthermore, you will receive a Schedule K1 if you invest in e-funds. So that might cost you more with your accountant when you go to file your tax return. But again, there's a silver lining here as well. You can avoid taxes on your Fundrise dividends and capital gains by investing inside an IRA. Fundrise offers both a traditional and Roth IRA subject to the annual limits set by the IRS. But if you plan on investing through an IRA, you need to have an account level of basic or higher and make sure you get the annual $125 IRA fee waived by investing at least $3,000 or more or maintain an account value of over $25,000. But the biggest downside is the illiquidity with Fundrise. You won't be able to touch the money for at least 5 years, and this is because real estate investing is by nature very illiquid once you own the asset. You can request early or full withdrawal, but subject to limitations and market conditions. And you will be subject to a penalty, which if you look here is a share of your withdrawal amount based on the length of time held. Because how Fundrise is structured, you should consider it only if you plan on reinvesting your dividends and want to diversify beyond the stock market. While the returns are attractive, you need to be comfortable with not being able to take your money out for at least 5 years. So if you feel like this meets your needs or want to check it out further, be sure to use a link in the description to go to their site or to sign up for an account. And by doing so, you help support this channel, so thank you. If you found this video helpful, be sure to hit that like button, consider subscribing to the channel and hitting that notification bell so you don't miss out on future videos. Thanks for watching, and I'll see you guys in the next video.